Okay, today we're going to talk about risk and capital budgeting, which is covered in Chapter 13 of your textbook. Now, last week we did Chapter 12, where we talked about capital budgeting, but the implicit assumption in that discussion was that we had perfect insight into what the cash flows would be in the future. In this chapter, though, we're going to recognize the fact that nobody has a perfect crystal ball, and so we just do the best we can at guessing or estimating what the cash flows will be in the future. And that leads to uncertainty, which we call risk, and that's what we're dealing with in this chapter. Now, any situation that has an uncertain outcome can be said to have a probability distribution. In this case, we're talking about a probability distribution of the expected cash flows. And a probability distribution is simply a listing or possibly a graph that shows the potential outcomes and the probabilities that are associated with those outcomes. So basically, we have two broad kinds of probability distributions. The first are the discrete probability distributions. And the key here is that there's a finite number of possible outcomes. And you can see an example in the chart on the right. Those are clearly discrete bars, and there's only a finite number of outcomes that are shown in that distribution. The other kind is what we call continuous probability distributions. And this is when there's an uncountable number of possible outcomes. In other words, you can assume that it's infinite, but in any case, you can't count them. For instance, in the discrete distribution, you might have a possible 1 or a possible 2 or a possible 3, but in a continuous distribution, you can have 1 and 2, but also 1.15 and 1.35 and so on. There's an infinite number of possible outcomes. Very often, we try to simplify the math associated with probability distributions by using a discrete distribution to approximate a continuous distribution. And you can see that red continuous distribution that I've overlaid on the discrete distribution. That is exactly the same distribution from below, except that I've changed the color so that it stands out a little bit. So you can see how well the discrete distribution would approximate that. And if we allowed for more possible outcomes, we could approximate it even better. Now, one of the first questions that we usually ask when we face uncertainty and a probability distribution is, where is it located on the continuum of possible outcomes? Do we think we're going to lose $500,000 or gain $500,000 or whatever? We need to know at least approximately where the center of this distribution is. And we do that by using the expected value. So here in this graphic, you can see I have two, let's call them projects, A and B has a higher expected value than A. So given a choice between A and B, we probably would prefer B. But the point is, we couldn't make that comparison unless we knew, at least roughly, where the middle of these distributions were. Now, we can calculate the expected value as simply a weighted average of the possible outcomes. And the weights are the probabilities of those outcomes occurring. And so in this equation, you would read this as the expected value of X is equal to the sum of the probabilities times the outcomes. So the rho, the Greek letter rho there, is the probability, and the X represents the outcomes. Now, with the normal distribution, since it's symmetrical, the expected value is the same as the arithmetic mean. That is not always the case. It's not at all uncommon to have distributions that are skewed either to the left or to the right, and in that case, the arithmetic mean and the expected value will be different. So it's important, if you know the probabilities, use them in the calculation. Now, in addition to the expected value, we also need to know how spread out the distribution is. So the more spread out the values are, the less certain we are of what the actual outcome will be. So you can think about this kind of in the sense of the range. So the range is the difference between the highest possible outcome and the lowest possible outcome. The bigger the range, the less sure you are about what will actually happen. And that's illustrated in this graph that I've put up here with two probability distributions. They both have exactly the same expected value, that light gray dotted line down the middle. But the red one is much more dispersed around that expected value, and therefore it represents greater uncertainty, therefore greater risk. Now, we can measure this uncertainty or dispersion around the expected value by using the variance. And you can see in the equation that the variance, ignore the squared term for just a second. If we do that, then the variance is simply a weighted average of the distance from the expected value. Now, the problem with that is if you don't square those deviations from the mean, then what you end up with is 0 every single time. And that doesn't do us any good. And the reason for that is because some of the values are going to be below the mean, some of them are above the mean, and the way that the mean is defined, on average, the deviation from that is 0. So what we do is we convert all of those into squared deviations from the mean. That makes them all positive, and then when we calculate the average, we get some positive, useful number. Now, the problem with the variance is that the units that it's measured in are squared units. So if we're dealing with dollars, for example, then the variance would be measured in square dollars. This is an unusual unit of measurement. We're not used to it. And so what we do is we take the square root, and that gets us back to the original units. And we call this the standard deviation. It's simply the square root of the variance. Now, finally, if the expected values are significantly different and you're comparing two or more projects, then it's a good idea to use the coefficient of variation. What this does is this removes the scale from the standard deviation. We do that by dividing by the expected value. And that way, the coefficient of variation from one project is directly comparable to another. We can't say that necessarily about standard deviation. Now, Excel has some built-in tools, functions, that we can use to calculate the expected value and the standard deviation and the variance. So for the expected value, when all of the probabilities are the same, or at least you have a symmetrical distribution, we can just use the average function. For the variance, Excel has two functions, var.s and var.p. The .s and .p simply tell us whether it's a sample variance or a population variance. You know, in most cases, if you have a large sample, the difference between the two is negligible. So it doesn't matter. But a lot of times in capital budgeting, we may be dealing with small samples, and in that case, it's generally better to use the sample variance rather than the population. And then finally, for standard deviation, we have stdev.s and stdev.p. Same distinction between the two. It's either a sample or a population. Now, as I mentioned before, sometimes we know the probabilities of each possible outcome. And especially if the distribution is skewed, then we don't want to use these functions from up above because they do not take into account those differing probabilities. So in that case, we either have to use array formulas or possibly regular formulas if you want to write some long formula. Sometimes we can get away with using the sum product function, but much easier than that is to use the user-defined functions that I've written in the famefuncs.xlam add-in. So in that add-in, we have functions to calculate the expected value, the variance, and the standard deviation. The main difference from Excel's functions is that these allow you to specify the probabilities. Now, when we need to deal with uncertain variables, we have several techniques for incorporating them into capital budgeting. So we're going to look at each of these in turn. So we have sensitivity analysis, scenario analysis, Monte Carlo simulation, the risk-adjusted discount rate, and the certainty equivalent approach. The last one, the certainty equivalent approach, really is more of a theoretical technique. It's not very often used in actual practice. And the reason is that it relies on knowing the decision maker's utility function. Typically, we don't really know what that is. So in sensitivity analysis, what we're trying to do is to identify the most important of the uncertain variables. So if you think about it, in any capital budgeting problem, we might have 100 or 200 or 300 uncertain variables. And what we want to do is we want to identify which of those are truly important in our analysis. So it's entirely possible that we might have some variable where if it turns out to be different than we expect, it really has no impact on the outcome. In that case, it would be not important and we would not really worry too much about it. So the idea of sensitivity analysis is to identify the important variables. In order to do that, we're going to change each variable one at a time and examine the effect that it has on some profitability measure, for instance, NPV. Probably Excel's best tool for doing sensitivity analysis is data tables. We've seen data tables before, but let me remind you basically what they are and how they work. So typically we have changing cells in a row or they're in a column. If they're in a row, as in the example that we're about to see, then we want to specify the row input cell. What Excel is going to do is it's going to take the values from the first row of your data table and it's going to plug them into that row input cell one at a time. So for instance, in this case, B9 is our row input cell. So Excel is going to take the values from the first row of our data table and plug them one at a time into cell B9 and recalculate the spreadsheet. And based on that, we can do some other calculations. So here I have an example from the chapter of a data table doing a sensitivity analysis. So let's just take the first item here. We're looking at how the change in the terminal value of the land affects the NPV. And so in column E, we're not changing the terminal value at all, and we get in row 39, we get the NPV with the terminal value of the land and everything else at their default values, which is 140,873. But if, for instance, we lower the terminal value of the land by 10%, you can see that the NPV will drop to 124,573, and so on. And in this case, I have 6 uncertain variables, and I'm doing a sensitivity analysis with each of them. And from this, we can identify the most important variables, the ones that have the biggest impact on the NPV. After we've done a sensitivity analysis, the next step is to take those important variables that we've identified and use them to create some scenarios. Typically, we're going to create at least 3 scenarios. We would have an expected case, where everything is as we expect it to be. We would have a best case, where all of those uncertain variables are at their best possible values. And then we would have a worst case, where all of those important variables are at their worst possible values. We could have several more scenarios if you want to take the time to create them. The basic idea behind scenario analysis is we run these scenarios, and that's going to give us one, say, NPV for each scenario. And then from that, we can get a better idea of the uncertainty around the expected net present value. Now, in this image that's just appeared on the screen, I have a scenario summary. So Excel has a great tool called the Scenario Manager that we can use to set up our scenarios and then see them one at a time if we want, or we can create a summary of all of our scenarios. And this scenario summary shows us the outcome of each scenario on one worksheet that the tool creates. So in this case, you can see I have a worst case, a base case, and a best case. And my important variables that I included in the scenarios are the catfish sales in pounds, the price per pound, and the variable cost as a percentage of the price. And you can see the values. So for example, the sales, the worst case is 125,000 and the best case is 275,000 pounds. And in the case of the variable costs, remember the higher the variable cost, the worse it is for our profitability. So in the worst case, variable costs are 65% of sales, while in the best case, they're 55%. And you can see that the NPV in each of these scenarios differs, of course. And in the worst case, we get a very low, about $193,000, negative $193,000 NPV. And in the best case, it's a little over 561,000. So this gives us a better idea of the possible NPVs. It's probably going to be somewhere between a negative 193,000 and positive 561,000. Now, the expected NPV, or the NPV of the base case in any event, is about 141,000. So if all you know is that base case NPV, you would accept this project, and you might not even think that there's a possibility that the NPV would be negative. But with the scenario analysis, we can see that a negative NPV is in fact possible. We can go a step further. This is just a regular worksheet that Excel has created, so we can do some calculations. And what I've done in this case is I've assigned probabilities to each of those scenarios. So basically what I've said is that there's a 20% chance that the worst case will occur, and a 20% chance that the best case will occur, and a 60% chance of the base case occurring. Using those NPVs from the scenario analysis and these probabilities, I can calculate the expected NPV, the variance of the NPVs, which is not terribly useful, and the standard deviation of the NPV. And then based on that, using Excel's norm.s.dist function, I can calculate the probability that the NPV turns out to be less than or equal to 0. So I can tell in this case that there's about a 25% chance that this is a project that I should reject. On the other hand, there's about a 75% chance that it's going to turn out to be a good project. Now we can go a step further from scenario analysis to what's known as Monte Carlo simulation. Monte Carlo simulation is, I like to describe it as scenario analysis on steroids. And the reason is that what we do is we harness the power of the computer to generate scenarios for us. Now, these scenarios are going to be based on draws from probability distributions. So what happens is we tell the computer about the probability distribution for each of our uncertain variables. So for example, in this example, I've said that unit sales has a normal distribution with a mean of 200,000 and some standard deviation. I've said that the unit price has a triangular distribution with a mean of, it's actually called the mode, of 2.5 and a minimum value of 2.25 and a maximum value of 265. Let me point out here that the triangular distribution really is not found in the real world, but it's very useful for simulation, because what we can do is we can ask somebody that's an expert, hey, what do you think the minimum possible value for the unit price is? And what is the maximum possible value, and what's the most likely? So with those 3 points, we've defined a triangular distribution. And then finally, I've said that the variable cost percentage is uniformly distributed, and that means that each possible outcome is equally likely. So in this case, I've said that it's uniformly distributed between 0.55 and 0.65, or 55% and 65%. Now, using those distributions, what the computer is going to do is it's going to draw randomly from that normal distribution for unit sales, and then draw a value from the triangular distribution for the unit price, and then draw randomly from that uniform distribution for the variable cost. And then it's going to plug those in to our spreadsheet and recalculate the model, giving us an NPV. And then it's going to do it all over again. And fortunately for us, computers don't get tired. They don't mind doing tedious tasks. And so we can tell it to do this thousands and thousands of times. What that results in is thousands and thousands of possible NPVs. And then from those, we can calculate all of the statistics that we're used to calculating, and we can get a much better idea of what the possible NPVs are, what the expected NPV is, and what its standard deviation is, and so on. So I have written a Monte Carlo simulation add-in called Excel Sim, and here is the main dialog box. We'll see this in action. I'm not going to ask you to do this on an exam, so don't worry about that. But basically all we have to do is tell it where our changing cells are. That's the changing cells. What cells to keep an eye on, that's the watch cells, and in this case that's simply the NPV, but you could say keep an eye on the NPV and the IRR and whatever else you want. We can tell it where the name of the watch cells are, or is. So in this case, A30 just says NPV, and that just helps to create a nicer looking report. Then we tell it how many iterations we would like to do. And to keep this manageable for the example, I've just said 500, and then you can give it a name for the worksheet that it's going to create. Now notice that at the very bottom, there's a checkbox there for screen updating off. It can be fun to leave screen updating on because you can see as the computer goes through all the calculations, you can see the model changing. But that dramatically slows things down, and so it's best to leave screen updating off. Now on the next screen, after you've hit the OK button, you're going to start specifying the probability distributions for each of the variables. And so here, I have the catfish sales in pounds, and I've told it that it is normally distributed with a mean of 200,000 and a standard deviation of 25,000. In that distribution drop-down list, there are, I can't recall, I think I have 23 or so distributions in that list. You're almost certainly never going to use most of them, but they're there if you need them. Now, after we've run the simulation and we have an idea of how risky the investment is, we need to incorporate this into our decision-making process. And we have a couple of ways to do this. The first is by using what we call a risk-adjusted discount rate, and that's often abbreviated as RADR. So what we do here is we simply adjust the weighted average cost of capital up or down depending on if the project is riskier than average or less risky than average. So the weighted average cost of capital really is the appropriate discount rate for an average risk project for this firm. If a project is significantly riskier than average, we would want to add some amount, some risk premium, to that weighted average cost of capital. The other method, which I mentioned earlier, is really purely theoretical, is the certainty equivalent approach. And here, instead of adjusting the discount rate, we adjust the cash flows. So the idea is that the risk-adjusted discount rate affects the discount rate. And really there, we're making two adjustments at once. We're adjusting for risk, but we're also adjusting for time. The certainty equivalent approach separates those two pieces. So we adjust the cash flow to adjust for risk, and then we discount those risk-adjusted cash flows at the risk-free rate to adjust for time. Okay, so that's it for the lecture portion. Next, we'll take a look at the Chapter 13 homework. Okay, so let's take a look at problem number 1. It says that Lemon, a scooter rental company, is currently evaluating two mutually exclusive investments. After doing a scenario analysis and applying probabilities to each scenario, it is determined that the investments have the following distributions around the expected NPVs. And then you're given a table, and you can see the table right here. So these numbers are possible NPVs for each project. Several members of the management team have suggested that Project A should be selected because it has the highest potential NPV. So if you notice, this NPV right here is higher than any of the possible NPVs for Project B. And so they're arguing that because of that, Project A should be selected. Other members have suggested that Project B appears to be more conservative and should be selected. So if you notice the range of possible NPVs for Project B compared to A, B has a narrower range of possibilities, and in that sense, it's more conservative. So they've asked you to resolve this question. So Part A says, calculate the expected NPV for both projects, and can the question be resolved with this information alone? Well, probably not, but let's go ahead and evaluate the expected NPV for both of these projects. So remember, what we want to do here is take each probability times each possible NPV and sum the results. And so the easiest way to do that is with an array formula. So I'll take the sum of the probabilities, and I'm going to freeze those, times the potential NPVs. And then remember, if you're using an older version of Excel, here you would have to hit Shift Control Enter, or on a newer version of Excel, just Enter will do. And so you should get 29,835. And I can copy that across, and you notice that I get the same result for project B. So here we have two projects that are mutually exclusive, so you can accept either A or B, or reject them both, but you cannot accept both of them. And obviously, if they have the same expected NPV, we can't choose based on that. Now, that's one way to do the calculation as an array formula. Another way to do it, same idea, is instead of an array formula like that, we could use the sum product function. So what this function does is it takes one array times another array and sums the results. So if I give it my probabilities and then I give it my possible NPVs, you see I get the same result. So before the new calculation engine, sum product was sometimes a way that you could avoid having to do the 3-key enter, so you didn't have to hold Shift, Control, and Enter. Now, one other way to do this is there is a FAME function called FAME expected value, and this works exactly like you would expect it to work. So I'm going to give it my values, and I will give it my probabilities, and I will freeze those and click OK, and then I get the same result for both projects. So any one of those three ways are legitimate ways to do it. My personal preference generally would be to use the sum function as an array. Now part B says calculate the variance and standard deviation of the NPVs for both projects. Which project appears to be riskier? Well, remember that whichever project has the higher variance or higher standard deviation would be the riskier project. So we need to calculate both of those to see which is higher. And you can guess here that A is going to be the riskier project if for no other reason than it has a larger range of possible outcomes. So for the variance, remember what we're going to do is we're going to calculate a weighted average of the squared deviations from the expected value. So we'll do, again, an array formula. So we'll do the sum, and we'll take the probabilities times, and we're going to take each possible outcome minus the expected outcome, square that. Now notice that that looks very much like the way that you would write out the equation for the variance. And you see we get a huge number. What is that? 2,403,361,408.6. Remember, we're dealing here with squared dollars. And so this number really doesn't make a whole lot of sense. That's not to say it's incorrect, just that it doesn't make a whole lot of sense. Now I can copy that over, and I get 817,827,883.2 for project B. So even though the numbers themselves don't make a whole lot of sense, the magnitudes do. And what you can see here is that B has a much lower variance than A. Also note that what we can do is there is a FAME var function, and this works very much like the expected value function. So we give it our values and we give it our probabilities, and we hit OK, and we get the same answer that we got before for both projects. So that's a little easier to remember. Now the one thing that you do not want to do, and let me do this off to the side, is you don't want to use Excel's built-in variance functions. And since we have probabilities, we have the entire set of possible outcomes. So I'm going to use the population version here and then just feed it the answers. And you can see we get a much bigger number. And the reason that it's so much bigger is that it's ignoring the probabilities. It's ignoring the weightings on those possible NPVs. And so this number would be wrong because you're throwing away information. Those probabilities are information, and we don't want to ignore them. So don't use the built-in Excel functions when you have probabilities. If you were dealing with just, let's say, historical data or something like that, then it's perfectly fine to use the built-in functions. But if you have probabilities, don't use those built-in functions. Now, the standard deviation is, of course, just the square root of the variance. So we can calculate those very easily. And as you would expect, the standard deviation of B is much lower than the standard deviation of A, and therefore we would say that B is the less risky project. Now let me show you, there's also a FAME standard dev function which works the same way as the other functions that we've looked at here. So that might be a little easier for you to remember, especially if you're not calculating the variance first. So we had already calculated the variance, and so it's a simple matter to take the square root of that. But if you haven't calculated the variance, then the standard deviation function is a little bit more involved, and that's where the user-defined function comes in and makes things easier. So project B is less risky than project A. Now part C says calculate the coefficient of variation for both projects. Does this change your opinion from part B? Well, remember that if the expected values are different, then it's a good idea to not quite trust the standard deviation and instead use the coefficient of variation. That's not really an issue in this particular problem. So this is not going to change our opinion about which one is riskier. But in certain cases, it can. And so it never hurts to go ahead and calculate the coefficient of variation. And remember, that's simply the standard deviation divided by the expected value. And you can see that the coefficient of variation for B is quite a bit lower than the coefficient of variation for A. And remember, coefficient of variation is simply the risk per unit of return, essentially. And so the lower number means less risky. All right, now part D says calculate the probability of a negative NPV for both projects. So I think I talked about this a little bit in the lecture. And the idea here is if we can safely assume that these NPVs are approximately normally distributed, and it looks like they more or less are, at least close enough, then what we can do is we can use a built-in function in Excel to calculate the probability that the expected NPV would actually end up being less than 0. Now, we could look at it here and say, well, if you look at these two values, they have a total of 30%, so there's a 30% chance of a negative NPV, but that's just approximate. And so we can get the exact calculation assuming a normal distribution by using the norm.s.dist function. Now notice that what this function is asking for is a z-score. And a z-score is just how far away is some number from the expected value. And so let me escape out of that, and I will calculate this separately. So this is a very straightforward calculation. All we're going to do is take the number that we're interested in, which is 0, minus the expected value, divided by the standard deviation. And so what this tells us is that 0 is 0.6, basically 0.61 standard deviations below the expected value. Now remember, the idea here is that if something is, let's say, 2 standard deviations or more away from the expected value, then that's considered to be kind of an extreme outcome. And it would be fairly unlikely to occur. So remember, with the normal distribution, anything more than 2 standard deviations away from the mean has approximately a 5% or less chance of occurring. So in this case, we're only 0.61 standard deviations below the mean. So the likelihood is going to be much higher than that 5%. And so we can calculate this with the norm.s.dist function. So I can give it my z-score, and then for cumulative, that means whether you want to use the cumulative distribution function or not, and we want the cumulative distribution function instead of the probability density function. So just remember that you need to put in true. That's the easy way to remember this. And you see that we get 27.14%. So that's the probability that the NPV would end up less than or equal to 0. Now we can do the same thing for project B. And this time I'll do it just all inside of the function. So my z-score is going to be 0 minus the expected value divided by the standard deviation. And then again, for cumulative, I want true. And you see that we have about almost a 15% chance that project B would end up with a negative NPV. And the z-score, if you wanted to see that separately, I can just copy that across. So that's 1.04 standard deviations below the mean. Part E says which project should be accepted and why. Well, it should be project B because it has the same expected NPV as A, but it's less risky. And that lower risk shows up as a lower variance, a lower standard deviation, a lower coefficient of variation, and a smaller probability of a negative NPV. Okay, so that'll do it for problem number 1. Next, we'll take a look at problem number 2, which is a capital budgeting problem where we're going to have to calculate the cash flows. Okay, so problem number 2 says that the Salida Salt Company is considering making a bid to supply the highway department with rock salt to drop on the roads in the county during the winter. The contract will guarantee a minimum of 45,000 tons in each year, but the actual quantity may be above that amount if conditions warrant. Management believes that the actual quantity will average 60,000 tons per year. The firm will need to spend an initial $1,400,000 investment in processing equipment to get the project started. The contract will last for 5 years and is not expected to be renewed. That's just a way to cut off the project after 5 years. The accounting department has estimated that annual fixed costs will be $350,000 each year, and that variable costs should be about $47 per ton of the final product. The new equipment will be depreciated using makers with a class life of 5 years. At the end of the project, it is estimated that the equipment could be sold for $150,000. The marketing department estimates that the state will grant the contract at a selling price of $60 per ton, though it may get some lower bids if the contract is open for competitive bidding. The engineering department estimates that the project will need an initial net working capital investment of $125,000. The firm's cost of capital is 10% and the tax rate is 25%. So Part A says simply set up a worksheet containing all of the relevant information in the problem and an operating cash flow statement that shows the total annual cash flows for each year, including the initial outlay. So right up here at the top, as usual, I have an input area where I've taken all of my assumptions. So remember, they thought that it would be about 60,000 tons per year on average. The revenue would be about $60 per ton. The equipment would cost $1,400,000, has a 5-year life, can be depreciated using makers over 5 years, and so on. So we have all of the assumptions up here, and then down here I've gone ahead and kind of pre-populated my annual cash flow statement for this project. And so we're going to calculate each of our cash flows. Remember, we need an initial outlay. That's the net upfront cost of the equipment. We need the annual after-tax cash flows, and then we also need the terminal cash flow, which is the non-operating cash flows at the end of the life of the project. Pretty straightforward, actually. So what we've got going on here for the initial outlay is we have the cost of the project, cost of the equipment, $1,400,000, plus, remember, we have that net working capital investment that we have to make at the very beginning. And remember, we wouldn't make that investment, and that's probably buying rock salt or something like that, unless we take this project. And so that's properly then allocated to this project. So we get an initial outlay of $1,525,000, and I'm going to bring that to the bottom as a negative number. So down here on this last row, I'm going to have all of my cash flows. In order to calculate the change in revenue, and remember, this is an expansion project for this company. This is not a replacement project, so we're not replacing anything. So we don't really need to subtract anything off. So the unit sales is important for calculating total dollar sales. So my unit sales is going to be 60,000 tons per year. And I will just copy that across. And so for right now, I'm assuming it's going to be the same number in each year because that's my expected annual tonnage of rock salt. Now my revenue or sales is simply the number of tons times the price per ton, which would be $60. So I get $3,600,000. And my variable costs are going to be the number of tons times my variable cost per ton, which was 47. And notice here that I've pre-set up some defined names, and this is because we're going to run the simulation later on. And then my fixed costs were given as, what was it, $350,000 each year. And then my depreciation, and I'm going to use Fame Makers for this. And remember, what we should do is surround this in if error, but I'm going to hold off on that for just a second. And so the cost of the equipment is our cost. We'll freeze that. Do not include the change in net working capital because that's not depreciable. And then our maker's class is 5 years. Freeze that. The year is year 1. And this is, again, this is just a 1 that's been custom number formatted. And then do I want to use the table or not? I'll just put in 0 for that. And so my taxable cash flows will be sales minus the total of my costs. And I get $150,000 for year 1. Now let me go ahead and just copy all of that across. And it looks like I didn't freeze something. And I did the same thing here. Okay. So those are my taxable cash flows, and then I'm simply going to take the taxable cash flow times the tax rate, and don't forget to freeze that. And then I'm going to add back my depreciation, and I'll just reference that up there. So my after-tax cash flow then is my taxable cash flow minus taxes plus my depreciation. So I will copy those across. And then finally, the bottom line here, I'm going to take my annual after-tax cash flow plus the terminal cash flow. And again, this is simply just in case I change this to, say, be a 3-year project or a 4-year project or something like that, then my terminal cash flow would not be in year 5, obviously, and I would want to add it on. And so I'm just allowing for that possibility. And I'm not actually going to do that in this problem, but I want to allow for it. My terminal cash flow is going to be the recovery of the $125,000 investment in net operating working capital, plus the after-tax salvage value for the equipment. And so over here to the right, I've set up another one of these little areas to make it clear what's going on in the calculation of the after-tax salvage value. So my salvage value is $150,000. The book value is the cost of the equipment minus all of the depreciation. So I would just sum those up, and I get $80,640. So clearly, I'm going to sell it for more than the book value. Therefore, it's going to be taxable, and the taxable amount is simply the salvage value minus the book value. Take that times the tax rate, and then my after-tax salvage value is the salvage value minus the taxes that they're going to owe on that salvage value. So my terminal cash flow is simply the change in net operating working capital plus the after-tax salvage value, or $257,660. And so that's my operating cash flow statement, and you can see these are my annual cash flows for this investment. Now part B says calculate payback, discounted payback, NPV, IRR, and MIRR of the project. So I'll start with NPV since that's how I have it set up here. And so remember, I'm going to give it my required return, my cost of capital, and then the cash flows in years 1 through 5, and then plus the negative initial outlay, or if you prefer, you could say minus that positive initial outlay that we calculated there. Either way, what you're trying to do is subtract off that initial outlay. So we get an NPV of $116,776.67. Clearly, this is a good investment, assuming that our assumptions hold. Now, for the payback period, we'll use the same payback function. And so we're going to give it all of our cash flows. And for the discount rate, remember, for the regular payback period, we don't discount the cash flows. So we could put in 0 or just leave it empty, which is what I will do. So it's going to take about 3.85 years to pay back. For the discounted payback, it's going to be exactly the same idea, except that we will give it a discount rate in addition to our cash flows. So we'll discount the cash flows at the cost of capital, and that'll be 4.7 years. The IRR, just give it all of our cash flows. We get 12.8%, which is greater than our 10% cost of capital, so it's a good investment. And for the MIRR, we'll give it our cash flows, and then remember, we give it our cost of capital twice. And we get 11.64%. So is the project acceptable? Absolutely. It has a positive NPV. That's really all that you need to know. But then we also know that the IRR and the MIRR are greater than our cost of capital. And we weren't given maximum acceptable paybacks, but really it shouldn't matter. Even if they said the maximum acceptable payback is, say, 3 years, the fact that this is beyond 3 years should not matter given that big positive NPV. So now part C says, if the state decides to open the project for competitive bidding, what is the lowest price you can enter without reducing shareholder wealth? Well, that's the price. Right now we have that set to $60 per ton. That's the price that would make the NPV equal to 0. And we saw a problem like this in the last chapter. So what we want to do is find the value for B4 that makes this equal to 0. So if we go to Data, What If Analysis, Goal Seek, we can set our NPV to 0 by changing the revenue per ton. So I hit OK, and I will go ahead and lock that in, and you can see that that's about $59 and let's call it 32 cents per ton. So the $60 per ton that we had originally, and I'll just go ahead and reset that, doesn't really allow a lot of room for us to adjust our bid. So if we bid $60 per ton, which is what they expect the state will be happy with, then we'll make a profit. If we feel like we have to bid anything less than that, we cannot bid much less than that. Now, Part D says perform a Monte Carlo simulation with 1,000 trials to determine the expected NPV and the standard deviation of the expected NPV. The uncertain variables and their probability distributions are given below. The quantity of rock salt sold should be simulated for each year independently of the others. In other words, we recognize the fact that in actuality, in each year, there's going to be a different number of tons of rock salt demanded by the state. It depends on how much snow and how many snowfall events actually occur. So each year will be different, so we'll have to include those as different amounts. Let's go ahead and set this up. Now, one thing that I like to do, and I've gone ahead and I've hidden it here, is I like to set up my simulation variables in the spreadsheet. They're not going to be used in the program, but I like to be able to see them and reference them. And so you can see that I have the amount of rock salt has a triangular distribution with a minimum of 45,000. Remember, they said that was the minimum that would be ordered. A most likely amount of 60,000 and a maximum amount of 95,000 in each year. And then my variable cost per ton would be normally distributed with a mean of 47 and a standard deviation of 3. And the actual salvage value of the equipment is going to be uniformly distributed with a minimum of 80 and a maximum of 200,000. So any value in that range is equally likely. So I have written an add-in for Excel that does Monte Carlo simulation called Excel Sim. Now, let me just warn you that this does not work on the Mac, and so I'm not going to ask you on the final exam to do a Monte Carlo simulation. I would love to, but since we have people that insist on using a Mac, I'm joking here, we can't do that, at least at this point in time. So if you've installed that add-in, it'll appear on the Data tab, and you can see over here the Excel Sim icon. So I will launch that. And then it's very simple. It's going to ask you, what are the changing cells? What cells do you want to keep an eye on? And how many iterations do you do? And then next, it'll ask about the distributions for each of those cells. So my changing cells are going to be my rock salt for each year. So I will select those, and then I'll hold down Control, and I will click my variable cost per ton and my actual salvage value. Now, my watch cells, what I'm concerned most about here is my NPV. I could select all of these, but I really only care about NPV. And then the watch name is just what's the name of that cell, and I'll just put NPV. How many iterations do we want? We want 1,000. And then if you want, you can give it a sheet name. Otherwise, it will just name it automatically. And then finally, note down at the bottom here, there's a checkbox for screen updating off. So it can be fun to leave screen updating on so you can see as things change, although it'll go by so quickly you won't really be able to tell what's going on. But Excel will recalculate much, much more quickly if you turn screen updating off. So generally, you want to have that box checked. Now I'm going to hit OK. And notice here it says year one sales, what is the distribution? Well, the distribution for sales in each year is triangular. So I will select that. And then the minimum is 45,000. The mode, or most likely, is 60,000, and the maximum is 95,000. Now, when I hit OK, it's going to ask me about year two sales, and that'll have exactly the same distribution. But remember, in Monte Carlo simulation, it's going to randomly draw a value for each variable from these distributions. And so the actual outcome in each year will be different even though the distribution is the same. So I hit OK, and now it asks for year 2 sales. And it's not asking by cell reference because I gave it a defined name. So here it says year 2 sales. Same distribution, I don't need to change anything. And then year 3 sales, year 4, and year 5. And now it's asking for variable cost per ton, which is a normal distribution with a mean of 47 and a standard deviation of 3. And then finally, it's asking about the actual salvage value, which is a uniform distribution with a lower limit of 80,000 and an upper limit of 200,000. Now, as soon as I hit OK, it's going to start drawing numbers from those distributions, plugging them into the model, and recalculating the NPV. And it's going to do that 1,000 times and then create a report. So I hit OK, and there is our report. And so you can see what happened here. For the first trial, it drew a random quantity, a random variable cost per ton, and a random salvage value, and it recalculated the NPV, and it came up with negative 521,000. And then for the second trial, it did the same thing again, but this time, based on those random numbers, it came up with an NPV of 660,000, and so on. Now, if I go all the way to the bottom, you can see that I calculate some statistics. So I have the minimum NPV, which was pretty bad, negative 1.374 million. The maximum, which was pretty good at about 3.8 million. The mean NPV of 375,000. And then a median, an average deviation, a standard deviation of those NPVs, coefficient of variation, and then skewness and kurtosis. And from skewness here, we can see that this distribution is going to be slightly skewed to the right. If it was perfectly symmetrical, skewness would be 0, and if it was skewed to the left, it would be negative. And then kurtosis, this is going to have a little bit of a higher peak and fatter tails than the normal distribution. You don't really need to understand that, I'm just pointing it out. So the main things that we're concerned about here are the mean and the standard deviation. Now, part E says create a histogram showing the probability distribution of the NPV. And so what I'm going to do is I'm going to select all of my NPVs, and then I will go to Insert, and Excel has this statistics chart area, and I can select histogram, and there you go. Let me make that a little bit bigger. And so you can see that this is slightly skewed to the right. So you see these outliers way over here. That's what the skewed to the right means. But for the most part, it's reasonably normally distributed. So let me move that a little bit out of the way. And then part F says, using the output of the simulation, what is the probability that the NPV will be less than or equal to 0? Okay, so let's write this. We'll say probability NPV less than equal 0. And there's a couple of ways that we could calculate this. Let's do it the way that we did previously. So what we can do is we can say norm.s.dist. And our z-score, remember, is going to be 0 minus the mean divided by the standard deviation. And then we'll say true for the cumulative distribution function. And we get about 28.66% chance of a negative NPV. So should you accept this project? I think so. Right? I mean, there's about a 71.5% chance that the NPV is going to be positive. And so that means that in most cases, this is going to turn out to be a good investment. Now, let's calculate this a little bit differently because we can use the actual output of the simulation. What we want to do is count up how many of those NPVs from the simulation turned out to be negative, and then divide that by the 1,000, which was the total number of NPVs, and that should give us approximate possibility that the NPV would be less than or equal to 0. So I'm going to use the countif function, and my range is going to be all of my NPVs, and my criteria, and you have to specify this as a string. I'm going to say less than equal 0. Now let me just stop right here for a second and hit enter, and you can see out of those 1,000 NPVs that we generated, 286 of them were less than 0. So now if we simply divide that by 1,000, and I really should just use the count function here, but I'm going to be lazy, then we get 28.6% as our probability. So this is an empirical probability. The first way we did it assumes that the NPVs are normally distributed, which is not quite correct, although it's close. The second way that we did it does not depend on any statistical distribution. It's just an empirical fact from the simulation that we ran. And if the distribution was dramatically non-normal, then these two numbers would be quite a bit different. But the fact that it's fairly normally distributed means that they came out to be about the same. So, should we accept this project? I think so, absolutely. Remember, I'm not going to ask you to do a simulation on the exam, but I did want to show you this because Monte Carlo simulation over the last 10 or 15 years has become a much more important technique because computers have come to be more powerful and able to run bigger and bigger simulations. So this is used in a lot of businesses, and it's used in finance in particular, especially in retirement planning, because there are so many assumptions and so many uncertainties that it's quite commonly used by financial planners. All right, so let's take a look next at problem number 3. Okay, now problem number 3 is a little bit different than the previous two problems. What we want to do here mainly is talk about how to look things up in a table. The rest of this is pretty straightforward. So the problem says Montrose Manufacturing is considering 2 potential investments. Each project will cost $115,000 and have an expected life of 5 years. The CFO has estimated the probability distributions for each project's cash flows as shown in the following table. And so that's the table that I have here. And the key thing to realize is that this probability distribution applies to each of the 5 years of the life. So it's going to be the same expected cash flow for each year. The company believes the probability distributions apply to each of the 5 years of the project's lives. That's what I just said. Montrose Manufacturing uses the risk-adjusted discount rate technique to evaluate potential investments. And remember what that is that's where we take the weighted average cost of capital and we add some risk premium, which could be positive, negative, or 0, to the weighted average cost of capital to determine the appropriate weighted average cost of capital for the project. As a guide for assigning the risk premiums, the CFO has put together the following table based on the coefficient of variation. So we're going to calculate the coefficient of variation, and then we're going to look it up in this table right here so that we know what to add on to the weighted average cost of capital. So part A says calculate the expected cash flow, standard deviation, and coefficient of variation for each project. So for the expected cash flow, and I'm just going to run through this pretty quickly because we just have done this previously. So I'm using an array formula with the sum function. And you can see that the cash flow for project 2 is a little bit higher than for project 1. And then for the standard deviation, I'll use the famed standard dev function. So my values are right there and my probabilities, and I will freeze that. Copy that over. So you can see that project 2 is riskier than project 1, And then the coefficient of variation is simply the standard deviation divided by the expected cash flow. And that confirms that project 2 is in fact riskier than project 1. Now down here below, notice how I have this set up. So I'm referencing my expected cash flow for each of the 5 years of the project lives. So that's just my table that I'm going to use to calculate the profitability measures. And then part B says, if the firm's cost of capital for average risk projects is 10%, what is the appropriate risk-adjusted discount rate for each project? Use the VLOOKUP function to calculate the cost of capital. So what we want to do, let's take project 1 as an example. It has a coefficient of variation of 0.3194. So we want to find that in the first column of this table and then return the risk premium that's associated with wherever we find it. Now the key thing is to note that 0.3194 is not in this table. So we can't look for exactly that number. We have to do what's called an approximate match. And the VLOOKUP function will do that for us. We can also use the XLOOKUP function, which I'll talk about as well. That's a new function, and it's more flexible and just in general better than VLOOKUP. But let's talk about VLOOKUP first, and that's an old function. It's been around forever, and it's a very commonly used function because we do a lot of looking things up in tables in spreadsheets. So I'm going to start with VLOOKUP. And then you notice it says that it wants a lookup value. That's going to be our coefficient of variation, a table to find it in, and then a column index number from which to return the result, and then what kind of a lookup do you want to do. So my lookup value is my coefficient of variation, the table, and you just select the values, don't select the headers, and I'm going to freeze that so that I can use it for project 2 as well. And then I want to return the answer from column 2, this column here. Now don't give it a range, just say 2. And then the type of lookup I want is an approximate match. This is the default for this function, so we don't technically have to specify this, but it's a good idea to go ahead and do that. And so you see that it says that the risk premium should be 0.5%. Now, how did it find that? What it did is it came to the first column of the table looking for 0.3194, and it said, nope, higher than that, higher than that, higher than that. Oops, I went too far, and then it backs up, and it chooses this value, and it returns the value from the second column. So again, it looks through column 1 until it finds the value or it goes too far, in which case it comes back. So it finds the 0.3 and it returns the value from column 2. Now to this, because this is just the risk premium, I need to add the corporate cost of capital. So I get a total cost of capital for project 1 of 10.5%. For project 2, let's see if we can figure this out in advance. So the coefficient of variation is 0.5186. So it's going to come here and say, nope, higher than that, higher than that, higher than that, higher than that, higher than that. But there is nothing higher than that, so it's going to stop here. And it should give us 2%, so our total should be 12%. 2% plus, 10% plus a 2% risk premium. And, oops, I forgot to freeze. Forget to freeze a lot of things. Forgot to freeze my cost of capital. And so I get 12%. For my profitability measures, this is very straightforward, so I'm just going to run through this very, very quickly. So we'll do FAME payback. And then FAME payback again. But for the discounted payback, I'm going to give it my discount rate, which is for the project. And then for my NPV, I'll use the project NPV. I'm sorry, project cost of capital. And then my cash flows plus my negative initial outlay. And then for profitability index, that'll be the NPV divided by the negative of the initial outlay plus 1. IRR and MIRR. Now, for modified IRR, my discount rate, or what Excel calls the finance rate, is the project cost of capital. And then my reinvestment rate can be either the project cost of capital, if you plan to reinvest in a equivalent risk project, or you could here say the corporate cost of capital. Doesn't matter that much which one you choose. They're close enough that it's probably not going to make a difference. And then hopefully I froze everything appropriately, and it looks like I did. Are these projects acceptable? Yeah, individually they certainly are. If they were mutually exclusive, then project 1 is a little bit better than project 2. Now, let's come back to our lookup, and let's use the X lookup function. So as I said, this is a new function, and it's an improvement on VLOOKUP. So VLOOKUP always looks in the first column of the table, which is not necessarily what you want. There are other ways that you can look things up where you can have a little more flexibility, but XLOOKUP gives you the flexibility to look in another column and return a different column and so on. So it's just a better function. It's also faster. So the lookup value for project 1 is our coefficient of variation. The lookup array is where do you want to look? And so we have to select that, and I'll freeze that. The return array, this can be any column in the table, so I'll select that one. And then it also allows what to return if it's not found, what the match mode is, and the search mode, and these other things. But really, we shouldn't need those. So what we should get right now is 0.5. And we didn't. Why not? So I forgot exact match is the default there. And what we want is the exact match or next smaller. And there we get 0.5%. And then I should be able to copy this over and get 2% for the other one. So that's the XLOOKUP function, and of course we would add the 10% to each of those to get the same answers that we got before. The main thing that I want you to understand here is that XLOOKUP is an improved version of VLOOKUP. So really, going forward, if you can trust that the people who are going to be using your spreadsheets are using a current version of Excel, it's better to use XLOOKUP. Okay? So that'll do it for problem 3 and for chapter 13, and in fact, that'll do it for the entire semester. So the only thing remaining, of course, is the final exam. I really hope that you found this class to be useful and that you learned a lot of valuable techniques. Trust me, if you worked hard on this class and you've mastered everything that we've talked about, you should be able to go out and just dazzle people in the office when you get a job. All right? So I will talk to you later.